Good morning from a chilly winter's Friday morning before a long weekend. Thank you for joining me for this webinar. I've actually lost count of what day we are in lockdown. Over 100. It's starting to feel a bit like Groundhog Day every day. But today, in terms of the webinar, some exciting things to cover. We're going to look at the dollar. Its recent weakness. It's had the weakest month in 5 years. So we're going to look at why that weakness is happening in relation to the 9-year bull market that the dollar has been in. We're going to look at gold. Gold's at an all-time high, over $2,000. How do you price gold? Should you be buying gold? We're going to look at tech. Tech as well in the US, huge positioning, huge valuations. Is tech something that we should be worried about? And finally, we're going to be looking at our new healthcare fund, which we launched this week. Just giving you a quick overview of it for those who missed the webinar, but quite an exciting place to be and invest in over the next decade. But before we jump into that, just a quick look at performance. We have positioned the funds for a low growth, low return, high volatility environment. I've seen a number of webinars that are claiming the same thing, but just to show that our positioning is actually working. We did position 2 years ago for a low growth environment, continue position for that environment. And as you can see here, our funds across the risk profile, from low equity to high equity, across the time horizons from 1 year up to 10 years, we're looking number one on the Alexander Forbes survey. So that is looking very, very promising. Similarly, if you look across single managers, over 1 year, second and third, over 3 years, first and second, 7 years, first and third, and 10 years, first and second. So strong proof that the positioning of the funds, both from a strategic perspective and a tactical perspective, working well in the current environment. I'm not going to spend too much time talking about Japanification today. I'm sure you're all tired of that, so I'll be focusing on the other aspects, the dollar and gold and healthcare. But at least the positioning is working well. Also comparing against other multi-managers, you can see there we are first across all time horizons. Quite surprising if you look over the 1 year period. This is the Sygnia Signature 70 fund. The dispersion across multi-managers is quite surprising. Normally, most multi-managers are so diversified across underlying managers, across asset classes, local and global, that they all tend to be pretty well diversified and not too different. But certainly over this 1 year, we've got from -6% at the bottom up to a +5% over the top. So big dispersion there, and very comfortable to see that again the funds are performing as we expect them to perform in this high volatility, low return environment. Okay, so jumping into markets. Most markets actually are higher on a year-to-date basis, higher than the start of the year. In fact, some of them are coming close to all-time highs. Certainly the Nasdaq is at a new high, as is gold. But generally, most equity markets are at new highs for the year and showing some strong growth. And this is causing some surprise amongst investors. But the chart on the left, bottom left chart there, shows the city economic surprise indices. The white line is Europe, the blue is the United States, green is China, and then the light blue is the world. And what you can see here is that the data from an economic perspective has been surprising to the upside. So as the huge pent-up demand from the lockdown is unleashed into the world, people have been forced to save, or those at least who've remained earning their salaries, have been forced to save. They haven't been able to shop, haven't been able to travel, and that money is finding its way into the economy and beating expectations across the board. Not only that, but if you look at earnings, the S&P 500 has had its highest quarterly earnings beat since 1992. So the earnings are surprising to the upside, the data is surprising to the upside, and all of that's driven markets to new highs. Now, admittedly, that's off a low base, so these aren't on an absolute basis great numbers, but offer a very depressed expectations, the data surprising to the upside. And as I've said before, what's known is priced into markets. Markets are reasonably efficient. And so it surprises in liquidity, surprises in growth, either to the upside or downside that drive markets. And now we're seeing surprises in economic data, as per the bottom left chart, surprises in earning data, as shown by the S&P, and that has driven markets to close to new highs. And we expect this to continue into Q3 and Q4. Global growth is going to continue to recover, and we don't expect the lockdowns to be a hindrance to that. So that brings us to the chart on the bottom right, where we look at what's happening now, 3 months into opening up the economies. Number of confirmed cases has certainly increased, but what remains consistent over the last 3 months is that the infection rates are lower post exiting the lockdown than to being in the lockdown. So once again, we're not seeing any consistent correlation between lockdowns and infection rates. The chart here, you can see most of the countries on the bottom right. This is from JP Morgan. Most of US states and countries, bottom right, showing lower infections now than before. So we're not seeing an increase in infections as a result of mobility and from a rate perspective. And similarly, we're now getting closer and closer and closer to a potential vaccine. So we had very positive data out from Medina, out from AstraZeneca, Oxford, and out from Johnson & Johnson on all their vaccine trials. So we're getting closer and closer to a vaccine. The infection rates, although they are peaking, and we certainly have hotspots, and it is creating volatility in the markets, we don't see a full-scale repeat of the lockdowns that we had in March and April. Yes, some minor adjustments to mobility, as we've seen in South Africa, and I'll talk about that when we get to SA, but overall, not going to impact growth in a major way. So from a market perspective, we're comfortable that growth is looking good, it's surprising upside. We don't expect the COVID-19 pandemic to influence growth in a meaningful way to the downside. So how have markets performed over the year to date? Well, we've got a new top performer, or second to top. If you look close to the bottom there, you've got gold, up 28% year to date, just behind global bonds at 29%, beating dollar cash at 23%. The dollar has weakened a bit, so overall actual cash is better, but dollar cash has weakened slightly. But there's been a lot of focus on gold being a stellar performer at 28%. At Sygnia, we don't have any gold in our portfolios, and I'm going to get to gold later on, but what's important to remember is that we have been overweight emerging markets. And you can see here, emerging markets from the lows up 29%, whereas gold is only up 22%. So the gold has been driven very much by a weak dollar. That is, it's not a supply story, it's not a demand story, it's a weak dollar story that's driving gold at the moment. And all weak dollar related assets have doing pretty well. So you can see here oil, particularly oil came off very low base, but oil has done nicely up 65%, helped by a weaker dollar. Emerging markets up 29%, helped by a weaker dollar. S&P 500 up 27%. So we had some very strong bounces over the last 4 months. On the top, the biggest loser is still South Africa listed property, still down 32% for the year to date. Very much a COVID-19 loser. We haven't seen any change to that. South Africa in general is showing similar stories. So our banks are close to the lows, March lows, property close to the March lows. SA retailers are equally struggling. So there's still strong differentiation in the markets where you're seeing defensives, tech, healthcare, gold doing well. You're seeing the lockdown losers, emerging market equities, in particular banks, across the world, European banks, American banks, and property stocks are all struggling. But what's important is markets are functioning well. Liquidity is back to normal. Markets are differentiating losers and winners, and it gives us confidence again that there's no need to panic. There's no heightened risk that's hiding behind any of these market moves. Okay, so let's look into the US and the dollar. The chart in the top right there shows the dollar movements over the last couple of months. Basically, over the last quarter, the dollar's lost nearly 9% of its value. And over the last month, it's the weakest month in the dollar in 5 years. It's a significant move from one of the most important asset classes in the world. So a number of things have been driving that. The US economic data has started to slow recently relative to the rest of the world. You've also seen the fastest increase in cases on COVID-19. And probably most importantly, from a US perspective, is the elections that are coming up in November this year. Trump is now 10% behind Biden in the polls. So you can see the bottom right chart there, that's from sports betting. That shows that how Biden is consistently widening his lead against Trump. But I do think that the betting odds are more accurate than the polls. But even if you look at the polls, Trump is now 10% behind Biden. He was behind Hillary at this point in time, and he did win in 2016, but he was only 3% behind. It doesn't mean he's not going to win, but it does mean that he has a stretch, and that means he's going to start or continue to saber rattle, continue to try and draw in voters, continue to try and detract from some of his disasters like the COVID-19 cases. And we've all seen recently how he has continued to make a fool of himself when he talks about COVID-19 in any way. So what is he doing? Well, he's causing a lot of trouble with China. He's picked China as the easiest target. He's trying to rally everybody against China. He has recently yesterday banned US residents from using TikTok and WeChat. WeChat being a Naspers or Tencent owned company. So we saw Tencent fall 10% nearly last night. It has recovered slightly this morning, and Naspers is down nearly 4%, or just over 4% today as a result of that. So Trump's tweets impacting the biggest stock in the South African stock market, and continues to cause volatility around the world. So we are prepared for this volatility. We do know that Trump is going to be causing some short-term noise. He implemented sanctions on Chinese and Hong Kong officials. He stripped Hong Kong of their visa-free travel to the US. He removed Hong Kong's special economic status. He rejected China's claims to resources in the South China Sea. And he's planning to prevent US pension funds from investing in Chinese stocks which are listed in the US. And he ordered China to close its Houston consulate, and then invaded that consulate that night in order to protect American IP. In a small way, an act of war by invading that consulate. So some really crazy things that are going on in the States when it comes to Trump, and all the distractions that he's trying to do to avoid people looking at what's happening at COVID-19 in the US. But what is fascinating is the fact that it hasn't had a huge impact on markets. So when Trump was attacking China a year ago and we had the trade wars, China was a massive loser. Chinese stock market fell 30%, dollar strengthened, and everyone saw Trump as being the hero. Now, with Trump's opinion polls falling, people losing confidence in the fact that he's going to be around much longer, all the saber rattling, what we saw in July was quite the opposite. In fact, the strongest equity market in July was China, up over 10%. And the dollar, as you can see, was the weakest asset class, over 9% from its peak. So the complete opposite impact on the market, despite a similar thing. An attack on China. We've had similar. The UK have decided not to use Hawaii. We've got Europe also looking at putting sanctions on China, and yet their stock market rallies 9%, so, while the dollar weakens. So certainly the fact that Trump's influence is waning means that markets are not taking as much short-term concern about what he's doing. Yes, a lot of volatility, and we expect the volatility to continue, but it looks like people are taking less of a concern for Trump overall in terms of everything that's happening in the US. So bottom line is that the dollar, we expect heightened volatility as a result of Trump to continue, with some weakness likely to continue as well. I'm not going to spend too long on this chart because I have mentioned it before, but what's most important to driving markets is liquidity surprises and growth surprises. The chart on the left there is the huge amounts of liquidity that's being pumped into the market to reflect central banks buying of bonds to support their economies. $1.4 trillion a month has been pumped into our bond markets, developed bond markets. And that's pushed developed bonds down to zero or negative levels, zero in Japan, negative in Europe, slightly positive in the US. And that's had an impact on gold. And again, I'll get to that chart later. But what we can see here is with these huge amounts of bond purchases, you expect bonds to be distorted. QE is definitely distorting bond prices. And that's why US bonds are close to zero. But you can see here in late 2018 when the US actually started to sell bonds, and then bond yields popped back up to 3% in the US. I don't think we're going to get there. I don't think the world can afford to unwind QE, but certainly we do predict QE bond purchases will slow down. They have to slow down, and as that buying slows down, bond prices will start to slowly mean revert to a slightly more normalized level. I'm not going to see 3% in the US, but from close to zero, they certainly should get above 1%. And that's going to have a negative impact on bonds and gold as a result. On the right-hand side, huge amounts of fiscal support, which is great in the short term. It is supporting buying. It will help the people to drive the economies faster. But in the longer term, as shown by the blue line, we are approaching quite scary levels of debt, which means, again, the low growth, low return environment over the next decade. South Africa. So there's a famous saying, more money, more problems. And when it comes to South Africa, unfortunately, we wish. Unfortunately for us, it's more debt, more problems. We spoke about the special adjustment budget last month, where our debt to GDP is already at 82%, where we need to fund a budget deficit of close to 15%, which means issuing huge amounts of bonds, which is why our bond curve is steepest it has been in history. At the same time, the government's trying to source money from overseas, and we have managed to achieve that. So the IMF approved a 4.3 billion loan in emergency funding. They were quick to note that there's a pressing need to ensure debt sustainability and implement structural reforms. We've heard this for a long time now. Tito did promise that we will see some structural reforms, or at least expense cuts in the medium-term budget policy statement in October. But there's a lot of skepticism as to whether that can happen or not. And not surprisingly, Cyril's recent survey showed that Cyril's confidence from the South Africa people has dropped 20%. The biggest fall in a long time, as people wonder what exactly is happening, why there are strange bans that are in place, where the logical consistency is happening with the COVID-19 lockdowns. And the chart in the top right shows a similar thing. So yes, South Africa, we did hit the world's 5th highest caseload. at one point, and as a result, there was some tweaks to our mobility. Alcohol was banned, schools were closed, although at the same time, they did open up interprovincial leisure accommodations, so give and take. But what's interesting is this chart on the right. And again, it talks to the fact of the low correlation between mobility, lockdowns, and the spread in the virus. So the first bar here is level 5. So this is the beginning of the contagion, the outbreak. It shows 7-day moving average of daily new cases. So this is level 5. So within level 5, the red line to Western Cape, you can see there our cases started to pick up towards the end. Level 4, the Western Cape was the first to accelerate and way ahead of the other provinces. Then the third vertical bar is level 3. And you can see here pretty much from the beginning of level 3, when 8 million people went back to work and we had proper mobility entering South Africa. From that point, Western Cape new cases has declined consistently. Then we had Eastern Cape peak as the virus moved up. Then Gauteng peaked a bit later, and now we're seeing a peak in KZN. So you do need to wonder as to the correlation between these lockdowns, that as you open up the economy, there's this decrease. And it points to the fact that we don't really understand the coronavirus. If you look at all other coronaviruses, all respiratory viruses, they tend to, after 2 months, they tend to exhaust themselves and tend to find a peak, and then the RT, which everyone was assuming, so the reproductive rate, which everyone was assuming was constant at 1 or above 1, that would stay at a constant level. But we're seeing now that generally after 2 months, this virus seems to just exhaust itself. I mean, we're still growing, but the rate is definitely decreasing in each region as a lag, 2-month lag passes. In fact, if you look countrywide, our reproductive rate is down to 0.68. That's incredibly low. And that means that instead of one person leading to spreading by a factor of 1, it's spreading by a factor of 0.68. So hopefully we'll see some announcements soon, and that our economy can open up further. We're just not seeing the data that points to the strong correlation between the lockdown levels, mobility levels, and the rate. That's something to look forward to. For now, the SARB did cut the repo rate by another 25 basis points, which is great. So we're now down to a repo of 3.5%. That's 3.25% cuts over the last year, which is certainly freeing up a lot of money into the economy. We've also continued to see strong improvements in terms of trade, with the platinum and gold prices rising to new highs, while oil stays low. Oil has recovered a bit. It's over $40 a barrel, but nowhere near what's happened to gold and platinum. So overall, some positive things and some negative things in South Africa. But the main one being, we need confidence that we are going to see structural reforms. We need confidence that the government is going to do the right things. We just need to have to see some positive signs in that direction. And so far, SAA has been restructured again, delayed again. So we haven't seen any key catalysts that give strong faith, and it's why we remain underweight South African equities. On the other hand, we are overweight South African bonds, and that's because of the huge yields as a result of the steep, very, very steepest in history yield curve, because people are worried about South Africa's ability to implement structural reforms. You can see here on the very right-hand side, there is South Africa with our 10-year bond yields fully hedged, basically risk-free in dollars, still giving the highest real yield in the world. So we do expect some support from global investors looking for the search for yield. Jumping into investment allocations. So Japanification I've spoken about before. I'm not going to talk about it too much again, but we still believe it's a good roadmap for our strategic asset allocation. Low growth, low returns, high volatility environment. It's important, very important to be diversified, to have low cost assets with a portion of passive, and to have some alternative assets globally, like the new healthcare index, which we just launched, ESG impact funds, and being tactical asset allocation to harness the volatility. But what I'd like to focus on is the dollar. And I have mentioned before that the dollar moves in 9-year cycles on average over the last 100 years, and we are approaching the end of the 9th year of a strong dollar rally. So we need to, we're not calling the top, but we need to understand when that could lead to a change. So the change has already started. I think that's important. Over the last 2 decades, the US share of foreign currency reserves has dropped from 70% to 60%. Slow, and yes, certainly in the US at 60% is still the reserve currency of the world, but it is waning. So the waning has already started. And now we're starting to see some big catalysts that I think could accelerate that move. So the one that happened over the last month was the euro. The euro got a boost relative to the dollar, and rose to quite strongly to 1.18 relative to the dollar due to a groundbreaking deal. And it really is a groundbreaking deal. So the EU Commission agreed to a 750 million euro bailout fund. But what they did for the first time ever is they're issuing that debt in euros. It's going to be a euro issued debt instrument combining all 27 EU members, leveraging the AAA credit status of the EU, and it makes the ECB one of the biggest bond issuers in Europe. But what's important, what's important about that is for the first time in the euro's history, it's a step towards fiscal union. So in the US has got it's got states, like Europe has got its member countries, and if one state is struggling, the Fed can just move money from one state to another state and support that state. In the euro, you don't have that. Yes, you've got a single currency, like the dollar is, but you haven't got fiscal union. Up till now, if Greece is in trouble, they've had to raise money through their own Greek bonds. So while we're not there yet, it's a blueprint, it's a roadmap. It means that before we get to the point where the euro disintegrates, and a lot of people have believed, and the reason why the euro hasn't been a big opposition to the dollar is people think that it's not going to survive. After Brexit, euro cannot survive. It will just disintegrate. There's no fiscal union. Now we have a roadmap and a possible solution. If we get to the point where another country, whether it's Italy or Greece or Spain, is in such trouble that it causes potential disintegration of the euro, or we've got a fiscal union solution. This makes the euro a really, really strong opposition to the dollar. And I mentioned last month that the ECB has set up a repo facility for non-Eurozone banks, again, following China, who did it recently, but again, allowing the euro to be a strong opposition to the dollar. Now we've got, if South Africa, instead of having all our foreign exchange reserves in dollars, we can now have more confidence in the euro, because there is a potential fiscal union. We've got far more liquidity because of this repo facility, and it just means that share of foreign currency reserves from 70% to 60%, we could see that accelerate. Not only the euro, but to the renminbi. And that brings us to the chart on the top on the right, which shows economic freedom. Now, China is far from China's got a lot of issues. I'm not saying that it's the perfect market model, but China's in orange here. You can, and the rest of the world is in grey. This is from the Heritage Foundation, and you can see here the vast increase in China's economic freedom. So China, in a desperate move to try and open up its economy, to try and attract foreign capital, it's been moving to less dependence on the government. It's less government control, interest rates, less government control of foreign exchanges, less government control of state-owned entities, just generally freeing up the economy. Meanwhile, we're seeing the opposite happening in the developed markets. The coronavirus and the huge amounts of QE and debt is blurring the lines between fiscal and monetary support. It's leading to governments buying stakes in banks, governments supporting companies that are too big to fail, and a huge amount of governments getting involved in the private sector. So we're actually seeing a decrease in economic freedom in the rest of the world, while China is actually opening up their economic freedom. It's the most ironic statement about markets you could ever think. You think of this big red Chinese state in the east and centrally controlled. Meanwhile, the US and Europe and Japan are moving more towards a state-controlled, and South Africa is another great example. We banned alcohol, we banned cigarettes. The government's more involved in our economy than ever, but we're seeing it across the globe, except for China, which is actually moving in the opposite direction. Which another reason why we think the renminbi could actually be a strong contender against the dollar. And that brings us to this chart on the right, which is from bottom right, which is from the World Bank and IMF. In 1992, 2008, and 2024, they're predicting that in 4 years' time, the top 5 economies in the world will all be in the East. China at the top, eclipsing the US, then India, then Japan, then Indonesia. Europe falls out of the top 5, US pushed to the top 2, and the East making up top 4 of the top 5 biggest global economies. I mean, it's just phenomenal. So when you're thinking long term, when you're thinking about the dollar and how it dominates, how it gives a structural advantage to the US, and that structural advantage could slowly start to wane. When you think that the S&P, the US stock market, makes up 67% of the MSCI World Index, and the US is soon going to be the second largest economy in the world, and even today on a PPP basis possibly is. We need to start wondering about whether the US stake in the world is going to see some headwinds. So we're not there yet, and we haven't made any changes to our strategic asset allocation. We just think that this is an important thing to think about. That economies rise and fall over. I think the average term is about, in terms of foreign currency reserves, about 80 years. If you think back to pound and its heyday. So we're not there yet for the dollar. It might be another decade, but certainly over a long-term perspective, we need to start thinking about who the next winners are going to be. And it looks like emerging markets, particularly Asia, ex-Japan, is their place to be. And what's interesting, if you look at the emerging market index, and we're about to launch an emerging market ETF on the EM50, MSCI EM50, this portion here, China, India, Japan, Indonesia, makes up about 85 to 90% of the emerging market index. Brazil, Russia, and South Africa, and other smaller countries, less than 10%. So emerging markets as a proxy, very nice proxy for this position, and we do think there'll be some strong demand for that emerging market ETF. So watch that space. Okay, so short term, let's talk risk management and TAA. So from a positive perspective, we remain confident that liquidity and fiscal support is exceeding expectations and more than we need. From another positive perspective, we're not concerned about lockdowns reverting back to the extent that they were. Yes, there will be hotspots or second wave, but we don't think it's going to distort growth over the next 6 months. And we think markets are going to start looking through that, particularly by the fact that we are close to vaccines. Yes, lots of volatility, but not huge pullbacks. The third factor is the dollar. We think there'll be increased volatility ahead of the elections, and we are positioned for that volatility with lots of levels of volatility harnessing derivatives in place. Then the last two are gold and tech. So let's look at tech as first, because it's the top right there chart. The orange line is big tech. So that's your FANG stocks, Microsoft. You can see here in the Y2K bubble in 2000, those stocks made up nearly 40% of the S&P 500. At today's levels, close on 45%. Nearly half the S&P dominated by a handful of stocks, all the big tech stocks. Yes, structural reasons why we do believe that you do want to have exposure to those stocks. There's always been a structural move away from bricks and mortar spend to online spend. Platform businesses have very strong business models. We're not disagreeing with that. But when the positioning gets this stretched, you do need to start to worry about the short-term movements. If you look at the market cap of Amazon, a phenomenal business, not denying that. Amazon's market cap is about 27 billion rand. If you look at the market cap of the JSE, the entire stock market of South Africa, 14 trillion rand. Amazon's nearly double the market cap of our entire stock market. Let's look at the PEs it's trading on. The forward PE of the JSE, 13. Not an unreasonable number. The forward PE of Amazon, 160. You might start to wonder whether that is a reasonable number. So Amazon trading more than 10 times the valuation of the South African stock market, more than double the entire market cap of the South African stock market. It's quite stretched, particularly when there are some headwinds. You know, we've seen Trump ban TikTok and WeChat. China could very easily turn around and ban certain US businesses or influence US supply chains. We've also seen the US itself strong antitrust movements against those big stocks, wondering whether the Facebook and Apple and Google don't have too much of monopoly and are leading to unfair competition in the US. So far, no strong movements against that, but particularly if the Democrats get in November, we could see some strong antitrust allegations lead to headwinds. So when positioning is this stretched, and when there are potential headwinds on the horizon, you may want to move to a neutral position on US tech. The other asset class to discuss, and just quickly on that, I mean, we still have overweights in our 4th R fund. 4th R does have small allocations to tech positions, and we still believe that that's a great place to be. It's well diversified. We don't see it as stretched, nearly as stretched as the FANG stocks. FANG stocks themselves are looking quite stretched, and we have gone underweight our FANG holdings. Looking at gold, so this is quite a nice debatable position. So as I said, Sygnia, we don't have any gold in our portfolio. We also don't have any global bonds. So the reason to hold gold and developed market bonds, particularly US bonds, is that they are uncorrelated to risk assets. So when equities fall, bonds and gold is supposed to go up. That's giving you some protection against losses, capital protection in particular. What we saw in March was the opposite. Gold fell quite hard. Global bonds fell quite hard. They didn't give you any protection. Only dollar cash gave you protection. And that's because QE has led to distortion of bonds. So what is gold? Well, gold is just a type of bond. You hold it for the same reason as bonds, like developed market bonds. It's an uncorrelated asset that gives you protection, or supposed to give you protection in market falls. So this chart in the bottom right shows the gold price in blue, and it shows that in purple shows the percentage of bonds that are giving you negative yields. So as bond yields have fallen, and as those yields, more and more bonds are giving you negative yields, so the price of gold has gone up. And this is understandable. It makes complete sense. Because if you want an uncorrelated defensive asset class, you can hold gold, or you can hold developed market bonds, US bonds, for example. When US bonds give you a slight positive yield, well, it makes more sense to hold those bonds because after tax, you're probably going to get a slight income. When bonds are giving you a negative yield, when you have to pay for the privilege of that capital protection, well, then you may as well hold gold, because gold is giving the same outlook, but it's not costing anything. And hence you can see here that as bond yields have fallen, which is the white line, as the percentage of bond yields that are negative has risen, the purple line, so the gold price has risen, the blue line. So what we expect when we see some normalization of gold prices, when QE doesn't stop, unwinds, when those monthly purchases drop from $1.2 trillion a month down to $200 million or $100 million a month, bond prices are going to normalize. Percentage of bonds that have negative yields will fall, not massively, but it might come down to its 2017 levels. But then gold, as a result, is also going to fall. So we continue to not hold gold. Yes, there are reasons to hold gold. I mean, there's huge amounts of QE. There's huge amounts of fiscal support, which we haven't seen in the last decade, and people are worried about inflation. We've got supply side disruptions because of COVID-19. A lot of people haven't been able to get to work, so there's a shortage of food, there's a shortage of commodities, all of which have pushed up some prices. People are worried about inflation. But demand has also been hurt far more than supply. And it has certainly made the debate about whether inflation does come back a lot more complicated than it's ever been over the last decade. Over the last decade, it's always been an easy debate to show that deflation is trumping inflation. So yes, there are some debates that inflation could rear its head, but we believe that Japan is still the best roadmap. They had huge amounts of fiscal support. They built roads, railways, and dams, and whatever you could think about, and never saw any inflation. So for now, we may change our view tomorrow, but for now, we still believe that despite the huge fiscal support and huge monetary support, that we're going to stay in a disinflation environment, and that bond prices are going to stay low, but which is going to allow QE to unwind, and that's going to lead to a fall in bond prices and a fall in gold. So we don't believe that those two asset classes give you the protection. From a South African investor, the easiest and cheapest thing to do is to put money offshore into cash. Dollars, euros, possibly renminbi. Those asset classes are giving you best diversification. The rand is still seen from a risk perspective as hugely skewed. Everyone believes the rand's going to blow out, and whenever any risk turns negative, as it has the last couple of days, it is your best shock absorber and your best uncorrelated asset class, and it allows you to exposure to things that do have income. So we're very comfortable having money offshore to protect, but rather than put in gold or overseas bonds, we've allocated money to our new fund, which we launched this week, which is the Health Innovation Fund. We do believe that aging populations are a structural thing that's going to be with us for a while. Aging populations will drive healthcare spend. Right now, healthcare spend is benefiting from increased government support for vaccines. We don't think that's going to go away anytime soon. But even if it does come off, the huge amounts of support happening in that sector because of aging populations, we think that that's the place to be. At the same time, we've also got our allocation to our impact fund, to our ESG funds, all of which see uncorrelated growth. Much more comfortable with those as asset classes globally. They're uncorrelated. They actually give you some income. They give you some growth. They're not just held like gold and double bonds as a pure let's hold it in case the world ends asset class. Because although it may feel like it, the world is not ending. Looking at our other tactical positions, so as I mentioned, we remain offshore, overweight global, but we do have protection against the rand in case it strengthens. Very cheap protection, so people believe the rand is going to weaken. That works well for us. We continue to avoid global bonds. We're underweight SA equity because South Africa just hasn't shown any catalyst yet that we are going to see improving growth. We are overweight global equity because global equities continues to move forward, particularly because they have stronger allocations to healthcare, and tech. And then locally, we continue to be underweight income and cash and overweight bonds. The 325 basis points cuts to our interest rates have put a severe dent in the yield you can earn on cash or income. The yield curve is so steep that there's a 5% difference from the short end of the yield curve to the long end of the yield curve. So despite the risk that remains from the medium-term budget policy statement, bond yields have to rise 100 basis points before you actually start to earn less in bonds than you do in cash. We don't think that we're going to see more than 100 basis point rise in bond yields. So we're comfortable to be overweight South African bonds, underweight cash and income for at least the medium term. Just a quick slide for those of you who missed the webinar yesterday on our new healthcare fund. Very exciting. 97% in the top 150 biggest healthcare stocks globally. This includes companies involved in COVID-19 vaccine development, such as Johnson & Johnson, AstraZeneca, Oxford, BioNTech, Pfizer. It also includes companies that are involved in COVID-19 treatments, such as Gilead and Bayer, companies involved in COVID-19 testing as well, Roche, Abbott Labs. Those COVID-19 related healthcare stocks make up 50% of the healthcare index by value. So we do think that there's going to be a medium-term support to that index, and then much longer-term support as a result of aging populations. And the healthcare has, although it's done relatively well, it hasn't done nearly as well as tech stocks, and it's not looking as stretched or over-positioned. There's also a 3% allocation to our Oxford Sciences Innovation Fund, which has got a number of companies involved directly with Oxford, so with COVID-19 vaccines, and there's some exciting things happening in that business. So overall, we're very excited about this portfolio. We have allocated a portion of the global equity from all our balanced funds into this portfolio. So if you hold the Sygnia balanced fund, you already have some of this, and we think it's a very nice diversifier. It's a very nice global alternative sector to have, and we think it will support the portfolios well through the current volatile times that we do expect over the next short and medium term. Thank you. I'm just going to quick squiz through questions to see if there's anything I haven't answered. There was a question here on the WIGB, South Africa, and we exited the WIGB. All that positioning is behind us. So it's one of the key catalysts that allowed us to be comfortably overweight South Africa bonds. The downgrade to junk has happened. The exit from WIGB has happened. So negative catalysts are out of the way. The biggest catalyst coming up is the medium-term budget policy statements. That is going to disappoint. Everyone expects it to disappoint in a huge way, and that expecting Tito to not be able to achieve any expenditure cuts. We think there's no chance he's going to achieve what he wants, but hopefully he'll achieve some middle ground, which should be a positive support to our bond markets. But even so, when you're earning double the yield, nearly triple the yield in bonds than you're on cash, a lot of that risk is justified. Process and NASPERS, good questions. We are firm believers in the SWIX index, and that gives us a larger exposure to NASPERS than the cap SWIX. The reason we prefer the SWIX index is because of portfolio construction reasons. The capped SWIX has a number of issues. Why is the cap at 10%? Maybe it should be 12, maybe it should be 8. Why is the rebalancing done quarterly? Could be monthly, could be annually. Why is the increased turnover so high? Is it justified? There are a lot of reasons why we think the SWIX is a better index, because it's a lower cost index. There's less turnover, less cost. And when we believe in a low return environment, the most important thing to do is reduce costs. However, the nice risk is something that is there. It is a concentration risk. It is nearly a third of the SWIX. While this is a great diversifier across when South African growth is so low and Chinese growth is so high, we're comfortable with that. We do think China and the East is a place to be, and we do think that Tencent's management are phenomenal. But the risk exists. So we do have layers, again, like we do in the currency, we have layers of zero cost protection over that, so that in our balance funds, if Naspers does have a pullback like it does today, well, we've got protection on it to reduce the downside. So again, it's clever use of volatility. You don't put on all the time, but like the currency, when the volatility allows, when the skews of those derivatives allow, you can put on protection that can be very low cost or free. What else is there? Just a little about the dollar moving in 9-year cycles. So yes, you go back over the last 100 years, look at the DXY index, you can see that the dollar tends to be quite a momentum-driven asset class, generally driven by economic cycles. It can strengthen in big waves that on average are 9 years. They tend to correspond with economic cycles roughly. Recessions tend to be catalysts to a change in both winners and losers, including the dollar. So this current economic crisis, this current recession could be another catalyst for why the dollar could end its 9-year strength. One of the reasons that I mentioned last month was oil. Over the last decade, the US has moved from an oil importer to being oil self-sufficient because of shale gas. The new normal is going to see much lower oil prices, which puts shale out of business, which A, lowers US growth, B, forces the US to import oil, both of which are negative for the dollar. Chinese debt to GDP is quite low. Certainly relative to other emerging markets, it might be on average, but compared to developed markets, it's quite low. It's also got huge foreign currency reserves. So if you net off assets and liabilities, yes, they've got debt, but if you net off their huge foreign currency reserves, the net position is actually quite low. They could very easily write off a lot of their debt and cover it with their foreign currency reserves. China and Japan and the East in general have very high savings rates as well compared to Europe, the US, South Africa. So again, while there is debt, if you look at that debt relative to savings, they can afford to take on a lot more debt than South Africa can, a lot more debt than the US or Europe can. So it's important to look at both assets and liability when looking at debt. But even on a gross basis, Chinese debt is not as high. If you include their shadow debt or their municipal debt, it gets higher, but still below South Africa and below quite a few emerging markets, and certainly below developed markets. Question on Reg 28 compliance. Yes, so Reg 28 doesn't impact living annuities, it does impact retirement annuities. There has been some question about prescribed assets. At the moment, we don't see any needed changes to Regulation 28. We don't see, driven from the government perspective. So the solution, Tito's solution for growth is same as Japan used, same as Europe and US used. It's fixed asset investment. It's building roads, railways. It's projects, infrastructure projects. However, what they want to do, instead of government borrowing money to do that, they want pension funds to get involved in that process. So there's a whole lot of risks around implementation and execution. However, current Reg 28 does allow allocations to private equity. It also does allow 25% exposure to fixed property. So you can probably get a lot of support for many of the projects without any Reg 28 changes required. It doesn't mean, so yeah, I don't think we're going to see prescribed assets yet or changes to Reg 28 yet, because what the government wants can be achieved in the current framework. Let's see, silver is a tough one. Silver tends to move quite, if you want to look at silver, a nice one is the gold over copper ratio relative to silver. Gives you a nice indicator of where silver should be. Silver has run pretty hard like gold has run. I think it's going to have headwinds that gold is going to have, while it should have some support from economic recovery. So I don't have a strong view on that. Apologies. Yeah, and just in terms of overall views, there's a view on the euro and the dollar. So the way we do tactical asset allocation is risk reduction. You know, I'm not telling anybody to sell dollars and buy euros. What you should be doing is what I think central banks are going to be doing going forward, and that's instead of only holding dollars, it's good to diversify. It's good to diversify your currencies, your global currencies across different assets. I mean, the US, roughly, we want to look at the global currency basket, and in a neutral perspective, it's about 60% dollars, 30% euros, and 10% yen. You know, so that's a neutral position, and something that you could use to build up a global cash position going forward, and certainly something that we are using to reduce risk, as opposed to taking a currency view. Quick question: Health Innovation Fund and OSI Fund, those are different. The Health Innovation Fund holds 3% of the OSI Fund. So the OSI is only available through an endowment, through a policy with a 5-year lock-in. The Health Innovation Fund is a unit trust, so you can get daily liquidity on that. That'll give you exposure to all the big healthcare companies and OSI, whereas OSI only gives you exposure to the Oxford companies. There has been some requests that for the Health Innovation Fund that we launch it as an ETF. We would love to. And we are engaging the JSE on that. Unfortunately, up till now, you can only launch an ETF on a passive index. And our Health Innovation Fund is active because we do hold OSI and we do have an active ESG overlay. So those unfortunately prevent us running that fund as an ETF. So anyone who wants to petition the JSE, please go ahead. Give us a support and we'll see what we can do. And that's it. So we're out of time. Thank you very much, everybody, for your questions and for tuning in. And yeah, I'll see you next month. Have a good August. Cheers.